Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, if we go to 101 or 102 or 103, obviously the out-of-the-money option, call options would not be a better investment, but a better investment would be the in-the-money or even the at-the-money options. So how you select your strike price is based on how much of a move you are predicting. If you buy out-of-the-money options, you're predicting a large move. If you are buying in-the-money options, you're looking for a smaller move. I hope that helps. Keep typing in your questions, and I hope to answer all of your questions. Had some great questions so far. Let's see. What else do we have here? Question about premiums. Where do these premiums come from? In fact, instead of me just giving you the answer, since I've been in this business for 30 years and have seen a lot of option calculations that have gone on over my 3 decades. How do you think these option premiums are calculated? How do we come up with the right values? Just type it in the chat box. Where do we get the right prices from? Where do you think the option prices are coming from? Well, believe it or not, the option prices are coming from market expectations, the future market expectations. So you'll notice that if you look at the Australian dollar, it tends to trade at higher volatility relative to the Canadian dollar. Anybody want to take a stab at why is the Australian dollar implied volatility, the actual option premiums higher typically than the Canadian dollar? Type it in your chat box. Why do you think the Australian dollar's volatility, the actual option premiums are higher than the Canadian dollar? Take a guess. Nobody's actually taking a stab at this one, but I think it's important for you to really understand options. You got to get a feel on why one class of options would have higher premiums relative to another. No one wants to take a stab at it? All right, let me make sure that I don't see any answers here. Nope. Oops. Thanks, KD. You're exactly right. Volatility. So if you looked at the Australian dollar versus the Canadian dollar, the Australian dollar is expected to be more volatile than the Canadian dollar. The Australian dollar is more likely to make a move up or down. Thank you, KD. That's exactly right. This is so important. I hope over the next 10 or 20 minutes, again, we've been at it for 30 minutes. We'll do another 10 or 20 minutes. Unless you have more questions, we're going to keep going. But I hope you're learning a lot. Normally, we bring in market experts to talk about where they think the Australian dollar is going to go, or we bring in market technicians. Well, my area of expertise is options. I know more about options than most people do, since I traded it for 30 years. But teaching them is sometimes challenging because I have to figure out what level you're starting at. And I'm glad that we actually were able to, you all were able to get the point of the volatility being so important. So if you look at option premiums and you see two currency pairs, both trading at 100, one has an option premium of $1.90, another one has a premium of $1.10. Well, the $1.90 premium, well, that means it's more likely that it might move up or down over the lifetime of the contract. So option premiums are based on future volatility expectations. I know it's a lot to swallow there, but I hope that it makes sense for you. All right, let's see what else. Question about the option Greeks. How do the option Greeks work? No, the option Greeks were released to the public in 1973. They were released the beginning of the CBOE, and it allowed option traders to have a general idea of what an option might be worth. And so what you would do is you'd plug in, as we just mentioned, the expected volatility, and then you could come up with an option's theoretical value. Of course, you'd need to know other things like where's the asset today, where's the strike price, time left until expiration, interest rates, dividends, if you will, and then volatility. Okay, so that all makes sense. But if I want to know how much my option might move, because an option is a derivative to the underlying instrument, well, then I would need this option pricing model. And the model gives me a general view, general sense of what an option might be worth. It is by no means a guarantee. It's just a general guess on what something might be worth. So, for example, going back to the Australian dollar trading at 100, the AUM parity, or 100, based on the ISE pair value. If I buy the 100 call today, and tomorrow the AUM goes to 101, which is obviously a pretty big move, goes to 101, how much should my call option go up, roughly, over 1 day's time? If it moves from 100 to 101, how much should my 100 call move up in value, roughly? I'm going to pose it to all of the attendees, trying to figure out what the delta of this option is. This is very important. It's the most important Greek. Katie, thank you. And at the money should always be about 50 cents. Exactly. Excellent. So that, again, this is really important. So again, I don't have any slides today. I'm just speaking extemporaneously on either subjects that I think are important or hopefully your questions. Next point that Katie points out is that the in-the-money might have a delta of anywhere from 80 to 90. That's exactly right. And if the in-the-moneys have very high deltas, like 80 or 90, then the out-of-the-money could be somewhere in that 20 range, exactly. So it would be the inverse. So if the in-the-money is 80, then the out-of-the-money might be 20. And so if I bought an out-of-the-money option and the asset moved up a point, well, my out-of-the-money option won't really move much. Maybe it might move about 0.20. So the out-of-the-money might move 0.50. The in-the-money might move, as Katie pointed out, maybe 0.8 or 0.9. So initially, you're always better off buying in-the-money option. If you're expecting a very moderate move, you're going to get a much bigger bang for your buck with the in-the-money option. But if you're expecting a huge move, you don't get the leverage with the in-the-money option. The out-of-the-money option gives you more leverage because you didn't pay that much for it. So I hope that all makes sense. Let's see. Let's get back to the questions. Guys, this is your time. On many of the surveys that I read, I get the one point is that please have more time for questions and answers. So this is your time. Here's another question. What's the difference between theta in an in-the-money option and an out-of-the-money option? Great question, Katie. And in fact, I'm going to pose this to all of you. Which option category has the greatest theta? In the money, at the money, or out of the money option? So you have three broad strike price categories, in, at, and out of the money. Which one has the greatest theta? Which one has the greatest, what I like to call extrinsic option premium? If you think about it, only one strike price does. Thank you, KD. The at-the-money option has the great, because you might see an option. I mean, I just gave you an example before. You know, let's say that the Australian dollar, the at-the-money options are trading at 2. They're intrinsically worth 0, but they're still trading at 2. The out-of-the-money options are trading at 1. The in-the-money options might be trading at 3.5, but they're worth maybe 2 or 3. So not that much extrinsic premium. The at-the-money options have the greatest extrinsic premium and therefore have the greatest time decay or theta. So if you're looking to benefit from premium erosion, you think nothing's going to happen, literally nothing's going to happen, you might want to look at a credit spread where you sell the at-the-money and you buy another option as a hedge. If you sell out-of-the-money options, nothing wrong with that. But again, that kind of trade is a more levered trade, and you're not going to maximize your theta intake, but you are going to do well if the underlier doesn't move at all. Maybe not just as well as the at-the-money option. All right, I'm turning it back to all of you, the attendees. And we have another, well, we have as long as we need. I talked about the Greeks. I'm just looking over my list of things that I might want to cover. Which strike price? Oh, here's another question. If I'm thinking about different months I should trade, what is, and I think all of you know this, what's one of the advantages of trading short-dated options, and what is one of the disadvantages of trading short-dated options? What is an advantage of trading short-dated options, and what is a disadvantage of trading short-dated options? Advantages and disadvantages. It's important to understand the advantages and disadvantages. Okay, Katie says short-dated options, you have, yep, short-dated options, you have gamma risk. So if you're long the option, you want the underlier to make a big move in a short-dated time, short period of time. If you're short the options, you don't want a big move. So yes, you have gamma risk with the short-dated options. That's exactly right. So the primary benefits of a short-dated option from the buyer's perspective is that they get to buy an option with a lot of gamma, and they don't pay that much for it. The disadvantage for a short-dated option is that there's not much time left for your forecast to come true. So I hope that's just, I hope that makes sense. Short summary of the short-dated options. Long-dated options have a different set of risks and rewards. Long-dated options, do they have a lot of theta or do they not? Long-dated options, do they have large theta, or do short-dated options have large theta? Long-dated options, what kind of theta do they have? Low or high? I'm not getting an answer. I'll give everybody another 20 seconds. Oh. Katie, number one, it's a very important. Long-dated options have much, much wider bid-ask spreads. That's exactly right. The reason being is that the option model, some of the inputs that go into the model, is not so certain. So the marketplace itself usually has a much wider bid-ask spread. That's exactly right. But theoretically, the options have much lower theta, meaning the time decay is much less. Much, much less with my longer dated options. Think about it. The theta measures how much time decay on a one-day basis. If I have 252 trading days left, the fact that the asset doesn't make a move in one day is, I don't want to say it's irrelevant, but it's near irrelevant. Not that applicable because you have 252 trading days. If you have an option that has 2 days of life left and it doesn't move after one of them, well, that's obviously 50% of the time, and that's a lot more important. So I hope that helps. All right. Well, I think it's time to turn it back to you. I think I've actually went through my outline of things that I wanted to handle. Believe so. Yep. Went through most of that. Now I want to turn it back to all of you, the attendees, and see if you had any other questions regarding the ISCFX options. Oh, question is from Katie. Can you use a married put for margin reduction? And the answer, Katie, unfortunately, is no. Here's the problem. Let's say you're trading at a certain broker, spot broker. It could be TradeStation. It could be Interactive Brokers. It could be a lot of people that will take your spot trade. The problem is that they're not, the margin is not covered for regulatory reasons. So you might have a spot trade, and you're going to have to actually handle the two margins separately. So you can't buy a put for margin reduction, but what you could do is, in lieu of your spot trade, you could buy an in-the-money option, let's say here at the ISE, and then sell an at-the-money option and trade what we call vertical spread. So you can do it that way. You could buy maybe an in-the-money call and buy an out-of-the-money put as sort of your collared trade. So you could do that. Second part of the question is, could you use a married option with the CME dollar, CME contract? The problem is, again, yes, you could trade something on the CME and you might be hedged. In fact, you probably would be hedged. On the other hand, for margin purposes, they won't view them as a hedge, and therefore you'd have to have more money up than you'd like to have. So even though you might be hedged, the two regulatory bodies, CFTC, SEC, are not looking at the same overview, and therefore that one contract wouldn't hedge the other as far as from a regulatory perspective or a margin perspective. Great question, Katie. Okay, we're coming into the home stretch here now. Another couple minutes. Please, this is your time to ask me a question. Anything regarding FX options. I'm trying to answer these. We've been at it for 41 minutes, and we'll be at it for the next couple minutes. Just want to remind everyone that January 26th, we'll be doing a basic ETF options terminology class. I'll be doing that. John Person, you won't want to miss John Person, February 1st. He's one of our more popular guests. And he'll be talking about his subject that I always find very interesting, is person pivot points. So again, that's something that you might want to check out. And then the same day at 4:30, Jeff Gibby from Thomson Reuters will be talking about an RMO trading strategy that he uses. And then on February 8th, we have technical analysis for FX options. And Mike Tuso will be with us on February 8th, beyond buy and hold. So we'll be talking about ETF options. Nicole Watts will be with us on February 15th, looking at the FX options. So again, I'm going to give everyone another 2 or 3 minutes. Just remember that these options are available. Oh, one other point. These options are available at 7:30 in the morning. So that's pretty neat. You can log into your account, whether it's, again, it's an E-Trade account, it's a Fidelity account, TradeKing, TradeStation, Options Express, what have you, TD Ameritrade. You can log into your account, and if you feel that something might be happening or it did happen over the previous evening in Asia and Europe, and you think it's going to continue, you might want to actually trade early, and so you can do that. 7:30 in the morning, our markets are available. So we open them 2 hours early now, 7:30, and they close at 4:15 Eastern Time. So at this point, I want to give everyone, let's say, 2 more minutes for any questions that you might have regarding ISCFX options. Oh, great, here's another question. Great. Question comes in from Tony, and I'm going to read it. On a put credit spread, and you have 100 delta. Of course, it's a negative delta, so 100 credit spread, you have 100 delta, and at 10 gamma, and price rises 1, the gamma helps. Put credit spread. I guess what you're saying, Tony, is you have multiple options, because you're not going to have, if you traded on one lot, you're not going to have 100 delta on that. But yes, I guess if you traded X contracts, you could have, be short 100 deltas and have negative 10 gamma, and the price rises, the gamma can help. So yes, gamma can help you. Gamma can hurt you. It just depends on the way you set these trades up. So now I'm going to set the clock again for another minute or two. KD says short gamma can kill you, and I like to say yes. When you buy options and it's a very quiet market, it's sort of like watching the paint dry. You wonder every day, why I'm watching the paint dry, and eventually something can happen. So a big move could occur. Just be careful. Try to think about the worst case scenario and how you'll deal with that. That's the way I look at options. Please, whether you're long gamma or short gamma. And Vega can kill you too. If you buy long-dated options, you have to watch out. And that's why you might want to use a debit or a credit spread on that longer-dated option so that you don't have such a big Vega exposure. So I want to give everyone another moment or two to type in any other questions, and I hope that today's class was very valuable for you. You took time out of your busy day to come and join us here at the IAC, and I hope that I gave you some value by answering your questions. So KD says, watch the vol crush when Google or Apple has earnings. That's exactly right. We saw that last week. The vol crush occurred. Occasionally, you're going to see the stock move outside that expected range, but it didn't happen last week, and we saw the vol crush. That's exactly right, Katie. Thank you. I'm going to give everybody another minute or so, and then we're going to wrap it up. I want to thank all of you for attending. Your questions were, I believe I answered them all, and I hope that all of you, I know that there were many people here in the class, not all of you asked questions, but I hope that you received some value from those that did ask some questions, and take this knowledge back, consider it, and if there's a trading opportunity that you see in currency options, please take a look at the IFC market. You'll be able to access the market right through your equity options broker. Also want to remind everyone that, again, this Wednesday, basic ETF options terminology class will be held 4:30 Eastern Time, and I'll be presenting. And on February 1st, we have John Person back with us, so please don't miss that one. And then Jeff Gibby later that day. So without further ado, I guess I'd like to just wrap it up and thank all of you for attending today's class. This is Steve Meizinger wishing you a safe and happy trading day tomorrow, and I hope to see you back here at the ISC as soon as next Wednesday when I will be presenting basic ETF options terminology. Thank you so much for attending. Trade safely. Bye now. On behalf of the ISC, Steve Meizinger wishing you a safe and happy trading day tomorrow. Bye now.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.